Stocks moving higher on the withdrawal of that controversial bill in Hong Kong. Some strategists say the bill's withdrawal is a positive for investor sentiment since they had feared that the protest could hinder any progress in U.S.-China trade talks. Gary Kaltbaum is here. He is the president of Kaltbaum Capital Management and a Fox Business contributor as well. David Nicholas with us as well. He is the president of Nicholas Wealth Management. Gary, on a scale of 1 to 10, how important is it for the U.S. investor, this gesture from Hong Kong's leadership to its people?
I'll give it a 5, but if it moves us closer to getting some sort of deal, I'll move it up to 7 or 8. But I think this is just a start. For this is great for the people of Hong Kong because this bad boy's been going the wrong way. I'm still leery of China. I think they're determined to take things over 28 years before they were supposed to. So keeping fingers crossed. For me, though, the big 10 out of 10. Our central bank's going to lower rates. I'm at a 0.5 point this month, and I suspect they'll go down to 1% Fed funds as we're down to 1.46 on the 10-year. And amazingly, the 30-year is at 1.9 and change. I think that helps markets. I'm not so sure it helps the economy because rates are already very low.
All right, Gary, I want to come back to the Fed and where you see rates going in a minute. I just want to bring David in on a somewhat related theme to Hong Kong because the U.S. and China still don't have a meeting date to discuss trade. China, we know yesterday, filed a complaint against the U.S. with the WTO. How is the U.S.-China trade war affecting your investing?
Yeah, I think there's two sides of this coin, right? Because it is good for the Hong Kong people, I think globally, that this gets resolved. But also, I don't think China could come to a trade deal with the issue going on in Hong Kong. I think this looked bad on mainland China. So I actually think they couldn't make a deal with this going on. But now that this could be behind them, this actually may embolden China, actually give them some cover to come from a position of strength. So I think there's another side to this that we have to look at as well, that this may prolong, now that this is behind us, prolong some of the trade talks that we're hoping to get some resolution. So for investors, I think the headline risk is key. This may embolden China. If that does, it could be bad for markets.
All right, Gary, getting back to your point on where you see rates, of course, almost at historic lows, right? Former NY Fed President Bill Dudley writing an op-ed style piece explaining another piece that he had written before, but he talked about not enabling President Trump. What is your take on the first piece and then, if you like, the explanation piece that followed the first piece?
Well, he went after the president because the president's been going after the Fed. But when he got some serious pushback for getting political, he's trying to just, bring it back a little bit. Look, there's a fight going on right now. The president says that the Fed is independent, and then he rips them to shreds. And the Fed, who is behind the curve, I mean, big time. The Fed should be a 0.5 point lower a week ago, not in a couple of weeks from now. So I get what the president's doing, but I don't want him to do it because I think you can cause chaos when the president says one thing and maybe the Fed's thinking another thing. But leave no doubt the most important part of the equation, I have to repeat this, easy money is here to stay, easier money's to come, and not just here. You got the maniacs in Europe that have negative rates. They're going to go more negative. They've printed trillions. They're going to print more trillions, and they're not alone. There's going to be other countries doing
Gary,
the same.
Let me ask you, though, for the U.S., and of course we've been following Europe where, to your point, it is so exaggerated at this point that you actually loan, in the Germans' case, you loan the German government money and you pay for that right to loan. So it is a pretty crazy idea. But let me ask you this. What do you say when people argue with you that the Fed shouldn't cut, that the U.S. economy is in great stead, and that some powder should be kept dry?
I just think the market's a lot smarter than everything. And when you have the 10-year down at 1.46 and Fed funds at 2%, you're just behind the curve. Simple as that. Fed funds should always be below the 10-year. It's been throughout history. And that's why you're going to see a 0.5 point cut here real soon. But again, I repeat, I think with the rates so low, I don't think a Fed cut helps the economy. It could help the markets, though. And the markets and the wealth effect have been a big help to the economy for 10 years. So I can't argue that point.
David, are you in agreement with Gary on the 50 basis points lower?
I don't think that. I think we'll see 25 basis points. Again, I do agree with Gary that I don't think the economy, for September, 25 basis points. I don't think the economy needs a rate cut, but I think we do need a rate cut when it comes to currency. So I think global trade, with lowering the interest rates, I think that does help us. When nations have floating rate currencies, we somewhat have to play in that field. So, I think it does help us globally with trade, but I don't think it's going to be a big impact to the U.S. economy.
I thank you both. Gary, David, be sure to join Gary. He is on Bulls and Bears this evening at 5 p.m. Eastern Time right here on Fox Business.